Imagine you have just landed $100,000. Maybe it is an inheritance, a bonus, the sale of an old asset, or years of disciplined saving finally paying off. You're sitting at the kitchen table staring at that number on your banking app, and one question keeps spinning in your head. Do I throw it into the share market and watch it grow on my own terms, or do I push it into superannuation and let the system do the heavy lifting? The choice you make today could be the difference between retiring with $600,000 or retiring with well over $1.2 million. Let us start with the cold, hard numbers. The Australian share market, measured by the ASX 200, has delivered an average annual return of around 9 to 10% over the long term, including dividends. This includes every major financial crisis and market collapse in recent history. Meanwhile, the average balanced super fund has returned roughly 7 to 8% per year over the last 3 decades. At first glance, stocks outside of super look like the obvious winner. More risk, more reward. End of story, right? Not even close. Raw returns are only half the equation. The other half, the one that actually decides who wins, is tax. When you invest $100,000 outside of super, every dollar of dividend income gets added to your personal taxable income. If you're a middle-income earner, that investment income is taxed at your full marginal rate, which can easily be 32.5% or 37% once you include the Medicare levy. That means your 10% return suddenly drops to a much lower after-tax return. While franking credits soften the blow on domestic shares, foreign shares and international ETFs get hit at your full marginal rate with no offsets. Inside the superannuation environment, it's a completely different game. Earnings are taxed at a flat rate of just 15%. Furthermore, capital gains on investments held for more than 12 months are taxed at an effective rate of just 10%. The ultimate kicker comes when you hit age 60 and transition your super into the pension phase. At that point, the tax on your earnings drops to exactly zero. You become legally invisible to the tax office on those returns. No other structure in Australia, not a trust, a company, or an investment bond, comes close to this advantage. Consider a 35-year-old earning $95,000 a year with $100,000 to invest. If they put it into a low-cost ASX 200 index fund outside of super for 25 years, factoring in tax leakage on dividends, they would end up with roughly $530,000 at age 60. If they instead contribute that money into super as a non-concessional contribution, it grows under the low 15% tax environment. After 25 years, that exact same starting capital with the exact same investment performance results in closer to $760,000. That's an extra $230,000 purely from choosing a different tax wrapper. But there's always a catch. Money inside super is locked away until you hit your preservation age, which is now 60. The government offers a massive tax break, but in return, you can't touch that money until retirement. For someone in their 30s with a mortgage, kids, or business goals, locking up $100,000 for decades could be financially crippling. Furthermore, super rules, contribution caps, and tax rates are subject to change by future governments. If you value flexibility and liquid capital to seize sudden life opportunities, investing in a diversified portfolio of ETFs outside of super gives you full control and immediate access. The real secret used by wealthy Australians is not picking one over the other, but building both. For younger individuals under 40, the flexibility of direct stocks provides vital liquidity. For those between 40 and 50, splitting the difference by utilizing both strategies captures both tax advantages and accessibility. For anyone 50 or older, super becomes almost unbeatable because the preservation age is close enough that the lockup period is no longer a major constraint. Your next move is simple. Check your super statement and ensure your money is sitting in the right investment option, as default funds frequently underperform high-growth options, costing you hundreds of thousands over a lifetime. Assess your personal marginal tax rate and decide if trading immediate liquidity for massive compound growth tomorrow aligns with your goals. The choice is yours.